Today, we're going to talk about this huge tug of war that's happening in the housing market. It's this massive standoff between what home buyers are hoping for when it comes to mortgage rates and, well, what the market is actually delivering. It really is a battle between hope and reality.
So let me just ask you, are you one of those people kind of sitting on the sidelines just waiting for those mortgage rates to drop before you make your move? If you are, hey, you're definitely not alone. Millions of potential buyers are in that exact same boat. But here's the thing. A pretty big problem is brewing. There's this huge disconnect between what buyers think is going to happen and what the experts are actually predicting. So let's unpack that. Okay, first up, let's look at the homebuyer side of this whole thing. What do people who are actually trying to buy a house right now think a good mortgage rate even is?
And get this, the numbers are pretty staggering. A recent survey found that a whopping 42% of potential buyers are holding out for a rate that's under 5%. And if you add in the folks hoping for something between 5 and 6%, you can see that, almost two-thirds of buyers are banking on some pretty big drops. This isn't just wishful thinking. It's the core belief that's driving how people are behaving in the market.
And it gets even more specific. For over a third of buyers, 37% to be exact, their idea of a good rate looks an awful lot like those historic lows we saw back around the Great Recession. They really believe that only a rate under 4% is a genuinely good deal. And here is the real kicker. This isn't just some casual preference. It's an absolute deal breaker. An incredible 94% of buyers say they will totally change their plans if rates don't fall below that 6% mark. I mean, the stakes for the housing market really couldn't be any higher.
All right, so that's the dream. Now let's hit the brakes and do a hard pivot into reality. What are the economists, the people who live and breathe this data, what are they actually forecasting?
And this slide just lays it all out, right? It perfectly shows the gap. On one side, you've got all these buyers dreaming of rates under 5%. And on the other, you have the expert consensus saying, no, look for rates to stick somewhere between 6 and 6.5%. That gap right there, that is the central fight in today's market.
So the bottom line from all the experts is basically this. Don't hold your breath for a big drop. The data is all pointing to rates kind of hovering in their current zone, not plummeting back down to those crazy lows we saw a few years ago. So you gotta ask, why? Why is there such a massive gap between what people hope for and what's actually likely to happen? Figuring out the why here is really the key to understanding this market.
Well, a huge piece of the puzzle is psychological. Our brains are basically anchored to the memory of those ultra-low pandemic-era rates, right? Which were closer to 4%. So after seeing rates spike like crazy to almost 8% in late 2023, yeah, the recent drop to around 6% feels like an improvement, but it's still nowhere near what we all got used to as normal. And, this gets at a really common misunderstanding that kind of fuels all these high hopes. A lot of people think there's just one person, one lever that controls mortgage rates. But the truth, it's a whole lot more complicated than that. The common thinking goes something like this. The Federal Reserve decides what mortgage rates are. The Fed cuts its rate, and mortgage rates drop right along with it. Simple, right? Well, not so fast. The Fed definitely has influence, but it does not have a magic button for your mortgage rate. The reality is, mortgage rates are more like a cocktail mixed from a bunch of different economic ingredients. You've got the bond market, which is a huge one. Mortgage rates tend to follow the yield on 10-year Treasury bonds. So when investors feel good about the economy, they see strong job numbers, good growth, they tend to sell off safer things like bonds. That pushes bond yields up, and mortgage rates usually go right up with them. It's this really complex dance between investor feelings, inflation fears, and cold, hard data about the economy. I mean, this quote from financial expert John Donikian just nails it. He says, how investors feel about growth and inflation expectations matters more than what the Fed says at a press conference. Basically, the mood of the market can often shout louder than any official announcement. Okay, so if we accept that rates probably aren't going to crash back to 3% anytime soon, how are buyers supposed to deal with this? What does this new reality actually mean for someone trying to buy a house? With that dream of a sub 5% rate kind of fading into the background, the affordability crunch is real. And it's forcing buyers to get, really creative. They're starting to look at options that would have sounded completely nuts just a couple of years ago. And check this out. Almost 1 out of every 3 potential buyers is now actually open to the idea of a 50-year mortgage. And for a jaw-dropping 38%, They see that lower monthly payment from a super long loan as literally the only path they have to owning a home in this market.
And that brings us right back to the main point from experts like John Donacan. The message for buyers is pretty clear. It's probably time to adjust your expectations. All the signs are pointing to a new normal where rates just hang out in this low to mid 6% range for a while, unless something big changes in the economy.
So, that leaves us all with a pretty heavy question to think about. As people start seriously considering things like 50-year mortgages just to get a foot in the door, you have to ask yourself, in this new reality, what does the word affordable even mean anymore?